So welcome to the class. In the last class we talked about the credit control function of the central bank, and we did the quantitative methods of credit control. And in this we are going to do the qualitative methods of credit control. They're also known as selective methods of credit control. And before we go on, just see how it affects, like we did in the last class. During inflation, if there's, what should be done with the bank rate is increased. So what, during inflation, again, let's just take open market operations. What should we do? We sell securities. So what should we do with legal reserve ratios? During inflation, we increase it. Now let's talk about the other thing. We're going to talk about during deflation. What should we do with the quantitative method of bank rate during deflation? Yes, you're right. So we're going to reduce the bank rate. And then what do we do in the open market operations during, see, I've written them here. During deflation, we purchase securities. And what do we do with during inflation? During deflation with the legal reserve requirement? Yes. So we decrease the legal reserve ratio. That means it is a sum of CRR and SLR. So right now we are going to do the qualitative methods of credit control. So these are also known as the selective methods of credit control. In this we are going to talk about margin requirement, we are going to talk about moral suasion, we are going to talk about credit rationing, and we are also going to talk about consumer credit. So just have a look. This is how we're going to go on. So talking about qualitative methods, they refer to those instruments of monetary policy of the central bank which direct or restrict the flow of credit to specific areas of economic activities. That is, who should get more credit or who should get less credit. So these, as I said earlier, they are called selective methods. Now let's just take, for example, margin requirements regulation. Now what is margin requirement? It refers to the difference between the amount of loan granted and the value of security offered for the loan. Margin is necessary because if a bank gives a loan equal to the full value of security, then bank will suffer a loss in case of fall in price of the security. The central bank influences the availability of bank credit by changing the margin requirement. For this, let's take an example. Suppose for a given house, the central bank allows only 70% of the value of a house to be given as a loan. The margin requirement in this case would be 30%. If flow of credit is to be expanded, the margin may be reduced to 20%. Now people will be more willing to purchase a house as they would get 80% loan of the mortgage property. So that is something about margin requirement. How does it regulate? Now talking about that, let's talk about moral suasion. It's very simple. It's just a way of persuading. Persuasion. That means in recent years the central bank has used moral suasion as a tool of credit control. It is a general term describing a variety of informal methods used by the central bank to persuade commercial banks to behave in a particular manner. Say in how should they behave in inflationary times and how in deflationary times. They just tell them how to go about it. So it's a kind of a form of a directive, and it's kind of a publicity. The central bank frequently announces its policy and urges the commercial banks to adopt it. The member banks generally do not ignore the advice of the central bank, who happens to be the leader of the banking and financial institution. So that is a way of persuading banks to fall in line. Otherwise, they do have those quantitative measures. Now let's talk about credit rationing. So what is credit rationing? I want you to see this. Look at this. So what is credit rationing? Rationing of credit is another instrument of selective credit control. It aims at limiting the maximum, that is the ceiling amount of bank loans and advances. And it does it in two ways. For example, one is the central bank may fix the maximum amount of loans and advances which can be given by a commercial bank. Or, secondly, the central bank may fix the maximum ratio of loans and advances of a commercial bank to its total deposits. So, in these two ways. And then we have what is known as the rationing of the consumer's credit. How to regulation of the consumer credit. So under this method, the credit given to durable consumer goods is controlled. Now, durable consumer goods are what? Like, yes, you're right, motor cars, houses, computers, etc. They are purchased under hire purchase system, and payment is made in installments. In times of inflation, the consumer credit is reduced, and in times of deflation, consumer credit is expanded. For checking inflation, hire purchase system is made limited.